And I think investors need to be a little bit defensive in terms of how they're thinking about the second half of the year. And I mean, who would have thought we would have seen the melt up that we did? And I think we've seen a combination of very short-term positioning in the market. We've seen a lot of electronic flow in the market that I think has been pushing the market higher. So I don't think we're going to see the doom and gloom, a deep recession, but I think a mild slowdown is something that we need to consider. But
Hi, everyone. Welcome back to the Investwell Podcast. This is episode 7, I believe. I am welcomed by Helen. Helen has over 25 years in the capital markets, recently joined iShares Canada as the head of iShares at BlackRock. Helen, welcome to the podcast.
Pam, thank you so much for having me. I'm excited for our conversation today.
Yes, absolutely. I guess maybe to kick things off, BlackRock, the largest asset manager in the world, a lot of investors pay attention to what you guys are looking at. I'm curious what is on the radar, what a lot of the conversations you're currently having with your clients. What should a retail investor be paying attention to right now?
Yeah, I think we can start off, Cam, by 2023 has been the year of expect the unexpected. And I certainly think no one would have predicted what we've seen so far in the markets. And I think, there are three key themes that we're talking about right now at BlackRock. Number one is that when we think about interest rates, we do think that interest rates are going to be higher for longer. And from that standpoint, we're holding tight at this point. Inflation is persistent. I think we're seeing it across the globe. In the last couple of weeks, we've had headlines from the UK, from Europe, and you're seeing inflation. And certainly here in Canada, you can't walk into a grocery store or have a conversation with a younger person about their mortgage and not feel the pressure that the average Canadian consumer is feeling at the moment. So I think certainly when we think about the Bank of Canada, and I was looking at some StatCan numbers ahead of us chatting today, and you look at the July statistics, and you're seeing both fuel and groceries. And groceries are, I think they were up 8.5% in July year over year. That's a little bit muted from what we saw in June, but the pace of inflation is still very, very high. It's running at twice what the Bank of Canada's target is. So I think, again, certainly here, our market is composed of financials, commodities, energy. We're running at high levels from an inflationary standpoint. So I think that one of the big themes that we're talking about to our end investors, to our advisor community, is all about that we do think globally we'll see interest rates higher for longer. I think number two, when I think about the markets, and as we were getting ready to start our chat today, we were talking about the Magnificent Seven, and certainly equity markets are priced for a very optimistic outcome. And I think investors need to be a little bit defensive in terms of how they're thinking about the second half of the year. And I mean, who would have thought we would have seen the melt up that we did? And I think we've seen a combination of very short-term positioning in the market. We've seen a lot of electronic flow in the market that I think has been pushing the market higher. So I don't think we're going to see the doom and gloom, a deep recession, but I think a mild slowdown is something that we need to consider. But that also makes the case, Cam, for a mild recovery. So that leads us to believe that certainly in the near term for markets, you need to protect yourself a little bit here. And when I look at where valuations in the markets are at the moment in developed market equity pricing, it doesn't really reflect a growth slowdown. And so I think you need to, and we're going to talk about flows in a minute, but I think you need to position portfolios to protect yourself a little bit if we see, and we've seen whipsaw in this past week alone, right? As the market, we were experiencing volatility. And I think lastly, mega forces, mega soon. When you look at demographics, when you look at artificial intelligence, they're impacting present day returns. And I think, powerful structural forces are really coming and intermingling with the macro backdrop that we're seeing. And I don't think we're that far in the future to really see positive implications for AI in the market, but at the same time, we're going through what I'd call a shift at the moment. We started the year with geopolitical fragmentation, right? We're seeing the unfortunate situation between Russia and the Ukraine with the war. Mm-hmm. You're seeing this term globalization start to shift away, and the rewiring of the global supply chain, and that's impacting production costs. We're also seeing government policies shift towards this transition to a low carbon economy. And that's also driving up energy costs. And at BlackRock, we think this could last over the next decade as we transition. Aging populations, when you look at the U.S. and you look at the inflation numbers out of the U.S., part of what we're seeing is worker shortages. And that is because a significant portion, or an ever-increasing portion of the population is aging. And as a result, that is impacting the cost. You can't get enough workers. You can't get enough workers going into a grocery store or into a Target or a Walmart. And that's a key constraint. And, that's fueling U.S. inflation and creating this tight labor market. Now, on the positive side, when we look at AI, that is going to help us from a perspective on a go-forward basis of offsetting some of the costs that we're seeing. But that's going to take time before we get there.
Absolutely. I think that's an interesting point to jump in on, because the market was relatively negative prior to ChatGPT coming about, and now it's really invigorated, the likes of NVIDIA. I think that's probably what powered a lot of that, the recent outperformance on that Magnificent Seven or Super Seven, whatever the terminology is. Do you guys see flow-wise that expanding breadth below just those top stocks into other parts of your product lineup, maybe more like inflation sensitive names or more like down market cap?
Yeah, so I think there's a couple of themes that we can talk about there. So number one, going back to sort of holding tight and rates higher for longer. One thing that we've seen obviously is very high cash positions in the marketplace. And we're recommending, and we've been seeing in the market, that investors need to think about stepping out of cash and potentially looking to fixed income. One of the most interesting things that we've seen, certainly in the past year, as people have really started, whether it's the end investor or institutions, you're seeing the play that fixed income ETFs have in the market. So if you've been overweight cash relative to historical allocations, you can now position using ETFs in the front, middle, or far out on the curve using an ETF. And this is fantastic, because when I go back to 08 or other parts of the cycle where we've had trickier markets, you haven't had the ability to use an exposure that allows you to get fixed income exposure through an ETF in a very low cost manner. So what we've actually seen is significant flows into fixed income. And certainly, depending on how you position yourself, our ultra short duration in terms of our iShares Floating Rate Index ETF, XFR, you get a higher rate than a HISA, and it moves with it. Certainly, we've been seeing people play volatility and reposition cash, and we've been out there educating that there are ways to position yourself using fixed income ETFs. Also, CMR, which is our iShares Premium Money Market ETF, has been another way that people have been positioning themselves. We have an alliance with RBC, and using target date maturity ETFs like the RBC Target 2027 Corporate Bond Index ETF, QRBP, is another way to be able to look at positioning yourselves using a fixed income ETF to build exposures within your portfolio. And last year, when you look at a traditional makeup where we saw both fixed income and equities underperform, this year has been different. And we certainly think that we want investors, we want people to be utilizing fixed income ETFs to give themselves that exposure. So that's been really interesting, and that has resulted in a lot of flows this year. The other theme that we've seen has been dividend and quality. And at iShares, we've really emphasized our view on the generational opportunity, not only in fixed income, but also positioning yourselves in equity in a more defensive manner. So again, looking for those quality exposures, looking at minimum volatility ETFs. So there's a wide range of exposures that, end retail investors can position themselves. So on quality, something like XQLT, which is our iShares MSCI USA Quality Factor Index ETF, has been one that's been popular. Also, any of our MinVol products, so the iShares MSCI MinVol USA Index ETF. And interestingly, you can play a MinVol ETF that gives you exposure to EAFE. So if you want to start moving away from what you think might be an expensive market in the U.S. through NASDAQ or S&P, and positioning yourself with downside protection using like iShares MSCI Minimum Volatility EAFE Index, which is giving you that EAFE exposure with downside protection to reduce your portfolio risk. So there's some interesting ways outside of looking at your equity exposure to find ways that are more defensive. And lastly, we talked about, Cam, those mega forces and mega exposures. And certainly as we transition to a real economic impact in the long run using AI or having that exposure to tech within your portfolio, whether you want AI value chain, the tools developers, the data services, the robotic manufacturers, looking at the theme of digital disruption, you can play this through exposures like iShares Exponential Technologies Index ETF, which is XEXP, or NASDAQ, iShares NASDAQ 100 ETF. There's Canadian hedged version of the product, which is XQQ. So these are all ways to look and play and get exposures within your portfolio to some of these mega forces. The other thing I'll just mention is when we talk about aging population, we have seen flows where people have been looking for that exposure to an aging population, that ever-rising share of the population that we talked about. And certainly when you think about aging population, but you want exposure to different markets where valuations certainly are not as high as we've seen in the U.S., you can look at things like iShares Core MSCI Emerging Markets ETF, which is XEMC, or iShares Core MSCI Emerging Markets ETF XEC. So all ways, Cam, that you can be looking at different exposures within your portfolio. And lastly, I'll say what's been most fascinating for me outside of fixed income has really been people looking for exposures to places like Japan. So XEF, that holds basically 24% exposure to Japan, which is our iShares Core MSCI EAFE exposure, is a great way. Or if you just want to play Japan itself, where we're seeing this transition happening right now, and we've had decent flows into CJP, which is our iShares Japan Fundamental Index ETF, has been an interesting place to be as well. So lots of different ways to get exposures within the markets using an ETF.
I think, to double click on a point previously on the fixed income sleeve, I think that's very interesting. There's been a ton of news around GICs and interest rates being so high, but then there's, you having to lock in to that.
Yes.
Do you find, and I know this isn't like an institutional product, a GIC, but are you seeing, I know back when we worked together a few years ago, there was a lot of talk with different portfolio managers on allocating more towards equities now because there's a lack of yield in the fixed income side. Are you guys seeing a return back to call it like a 60-40 portfolio and professional investors leveraging a fixed income ETF?
100%. So it's been interesting. If you look at Canada industry-wide, Cam, ETFs have brought in, even in the last quarter for Q2 2023, about $9 billion in flows. And fixed income has been about 60% of that. From an institutional perspective, when I connect with our institutional distribution team, it's been really interesting. And we've been spending a lot of time educating professional portfolio managers to use an exposure on the fixed income side to really be able to leverage yourself, even short term, layering around your equity exposure. And I think, when you look at fixed income ETFs, certainly from our own flows, we've had excellent, and even today I was talking to our capital markets desk, XBB, which is our iShares Core Canadian Universe Bond Index ETF, we've had significant flows, some of the highest flows in fixed income in that particular product, and then also in XGB, which is our iShares Core Canadian Government Bond Index ETF. People have institutionally have been positioning using that product. So that's led on our capital markets desk to chunkier flows coming from institutions who, again, traditionally would have gone to one of the Canadian banks and bought a traditional fixed income bond or, and paid higher fees. What is happening now with the evolution of fixed income ETFs and the liquidity that's come to this part of the market is, as an institutional PM, you can get exposure to fixed income in a really liquid, easy manner.
I really like that. I think, that is an area that we have focused in on too with InvestSpot when we've written a lot of our own research is, being 100% equity or like going like the Wall Street Bets road on taking a lot of big swinging bets is not, that may have worked a while ago. It's not going to work today. The fixed income side is an important part of anyone's portfolio. Obviously, if you're a very long dated investor, having a big piece of that's maybe not as important, but as you look towards your retirement goals or you're saving up for a big purchase, that fixed income ETF can give you that liquidity exposure. It's very important, I think, to start considering, especially in this sort of market.
Yeah, and Cam, as an end investor who's participating in the market, and you think about you're saving on a monthly basis and using a TFSA, being able to in your TFSA use ETFs really for that easy source of exposure. Because really, when you look across equity, look across fixed income, you have the ability to, on a monthly basis, be able to go in and save a certain amount of money, say it's $500, $1,000 a month in your TFSA for a period of time until you cap it out. But you can use an ETF as the most liquid instrument to give you an exposure to emerging markets, to fixed income, if you want to play these mega forces that we just talked about. So there's really an ETF that solves pretty much any exposure that you want to have. But what's amazing about it is in the morning, on a Monday, you can decide you want to own a fixed income ETF. And then on a Friday, decide that the market has changed and you want to sell that. And because of the liquidity profile and the access that an ETF gives you, it's really easy to be able to do.
Yeah, absolutely. And you raise another interesting point on being focused around quality. There's been a lot of focus by these massive tech companies to pivot away from growth to focusing on cash flow, specifically free cash flow, which is a primary stream for a lot of different quality funds out there.
Right.
You might not be able to speak to this directly, but I'm curious, when you guys, within your quality ETFs, are you seeing more tech exposure come into play?
Yeah, so I think there's a couple of things. When I look at our factor lineup and I think about the quality factor in essence, our iShares MSCI USA Quality Factor Index ETF, which is XQLT, has been an area that certainly we've recommended to end investors that is giving that quality wrapping to someone who wants to have that within their portfolio. When you think about tech, I think, again, you want to be thinking about, do you just want, Cam, a plain, or not plain, but do you want access to the NASDAQ 100? You can do that in a Canadian hedged way through our iShares NASDAQ 100 Index ETF, which is XQQ, or if you want to play digital disruption, you can do that through iShares Exponential Technologies Index ETF, which is XEXP. I think it, again, goes back to what are you looking for within your portfolio? And if you're looking for playing a particular theme, you can probably find an ETF. And certainly going to our iShares Canada website or rbcishares.com will allow you to go on and see certainly our iShares lineup here in Canada to be able to really play any of these themes, or look at something very specific like a factor ETF like quality that we just talked about.
Yeah, absolutely. Or they can go onto InvestApal and do those filters as well.
Absolutely, we want people to go on to InvestApal and look. But I do think, the amazing thing, Cam, you've had exposure, and you come from capital markets in ETF and researching ETFs. You've got a wealth of knowledge. But this is the amazing thing from having a career in traditional equities. ETFs now do provide, whether you're an everyday investor, whether you're looking to save and you want to have a lens that is dividend focused or focused on quality, ETFs allow you to do this. And I think, it's a really interesting evolution in capital markets and I think the liquidity profile, certainly from a perspective of iShares, being, when we look at the liquidity of a number of our larger ETFs from an AUM perspective, really allow you that nimble access.
Yeah, absolutely. I mean, originally the intent that we launched InvestPal around was, put like XQLT in your portfolio. That can be a massive weighting within it. And then you can go and layer in some of these smaller bets on, like, whether that be asset allocation or like exposure to Japan, as you mentioned earlier. As a smaller piece of your pie. You can keep your core holding, like 90% of your worth, in one of those diversified index ETFs, and then to a lesser degree, some of these more targeted exposure areas.
Well, Cam, what excites me about digging around with my 20-year-old son last night on InvestApal, the website, what you and your partner are building is really exciting, because you're allowing the end investor to come in and build a portfolio, share it, educate, but build those exposures. Of course, there's not just iShares that are out there when we look at the Canadian ETF industry, which continues to grow. So there's really access for anything that investors are looking to get exposure to. But I will say, from our own lens, I think it's really interesting what you're building, because, again, you're giving that access and education to people who are coming into the market and trying to learn.
Yeah, no, yeah, absolutely. I really appreciate that. I guess one final question.
Yeah.
You focused in on the EAFE and Japan as an area of opportunity for people. It's something that we've focused on as well. I think there's obviously a very big Canadian bias and also a big North American bias to people's portfolios. Are you starting to see a diversification away to more emerging markets now and overseas?
Yeah. So, it's been super interesting to see our end investors look to, I think it's really a question of looking at valuation, and as the market melt up that we already talked about, Cam, that end investors, that institutional investors have been experiencing. It's been, okay, what does the second half of the calendar year look like? And certainly when you look at valuations and you look at some of the data points coming out of emerging markets, there's opportunities. And I have been watching with fascination of what's happening in Japan, because I think we're going through a once in a lifetime. We're watching a movie as Japan starts to find their feet and change their macro policy. And as a result, when you look at something like iShares Core MSCI EAFE Index, which is Europe, Australia, and the Far East, you're seeing some really interesting trends, and that certainly has followed in flows. And that flow, I think, has been a mixture for us, both of and retail investors, but also institutional investors who within their portfolios are looking for certain exposures and moving money into these types of ETFs. So to me, it's been fascinating, and I think it's something that we're going to continue to watch as we move forward.
Okay, very interesting. And as in a concluding thought, a lot of the people we end up chatting with, they have difficulty getting started investing and figuring
Right.
out, where is that starting place. I know you guys have a lot of, like I mentioned earlier, like the XQLTs of the world, like an all-in-one ETF. Is there anything else on the radar that you think is worth calling out to a newbie investor looking to get their feet wet investing on their own?
Yeah, so I think, what I love about whether it's on the capital markets lens or from an asset management perspective is, markets, you don't know in the morning what you're going to come into and learn. And I think education is so key when you're trying to put your toe into starting to invest. And obviously through the pandemic, we experienced this meme melt up and valuations like I've never seen, and really new investors coming to the market. But I think what's interesting about that is we've brought and introduced a whole new set of investors to markets. And what's so empowering for me is that, again, we talked about TFSAs and we've talked about structure where, we've watched globally at BlackRock how in different parts of the world you have started to see savings plans, ETF savings plans come to life. You look at Germany and you looked at how structurally the markets in different parts of the world have created people getting interested in the market, but structural savings. And we want to empower people at BlackRock and end investors to have financial independence and to educate themselves and have tools for access. And really we're about investor choice and we're about empowering the end investor. And so I would say, Cam, places like InvestApal, places like reading the paper every day and paying attention. My 20-year-old, I learn a lot through his eyes. He's reading the Financial Times every day and wanting to understand, how to invest his own money. And I think this is very, very empowering, and it excites me for future generations to have independence and to be in control of finances.
Very exciting. Helen, I was very pleased to have you on. Lots of different products you threw out there. We'll go back. We'll put all of those in the show notes for anyone interested in specific iShares products, both Canada and the US that you mentioned. If anyone is interested in investing in those. Helen, I know you don't have a public platform per se, but if people are interested more on the learning about BlackRock's outlook, where could we turn our audience towards?
Yeah, so again, I think I've mentioned you can go to iShares Canada or BlackRock.Canada, BlackRock.com, and you can find lots of interesting educational information, as well as RBC iShares.com, where it's listed all of our combined ETFs and lots of good education. So those would be two places that I would point people, or three places, I guess I would point people to.
Okay, amazing. Well, thank you once again. Hopefully we can have you on in a few months or so.
Well, I look forward to watching InvestApal continue to grow, Cam, and being a fantastic spot for people to educate themselves on that financial independence and gaining tools for access to the markets.
Absolutely, yeah. It's a problem I think a lot of different Americans and Canadians face.
Yeah. Thank you so much, Cam.
Thank you, Helen.